Well, let's get into our next discussion here, and it's all markets. We have Stefanie Holtze-Jen, Chief Investment Officer, Asia Pacific Private Bank at Deutsche Bank. We have Mayank, Khemka, Chief Investment Officer, India, and Head of Discretionary Portfolio Management at Deutsche Bank here in our studios. Thanks very much, Stefanie and Mayank, for being here. Appreciate your time very much. So let's just start with the global stuff, which I think is the bigger overlay, macro overlay in that sense. And I think the general kind of consensus expectation is that markets have done very well, especially the US and India. Both markets have done, they've been some of the best performing indices amongst large markets over the last few years. We in India have got a bit of a cyclical, seasonal slowdown. US is chugging along very nicely, 3% growth. President Trump is saying America first. So they're trying to juice up the economy and things should look good. So why should money go anywhere but the US? That's the broader thesis that you kind of begin with when you speak with, and that's a consensus view. Would you disagree? And what are your thoughts?
It is a very challenging backdrop, as you just explained, and especially for here in the region. Every region that does not have a sufficient interest rate gap that is positive to the US will suffer even more. Like India is not part of that right now. So from that angle, this should not be the kind of backflip for not investing in India at all. India has been a very important investment call for us. From last year, we carry this forward into this year. But I have to admit, US and equities in particular remains the first port of call for us. You
mentioned interest rate differentials, but in the US, there is a very concerted effort to bring down the size of the government, cut spending by about trillions of dollars, basically. We'll see what happens.
Yes.
And I think last night the Treasury Secretary in the US said that his focus is the 10-year and he wants it lower, and it'll happen. So, I mean, that the interest rate differential how much will that matter if they are successful in any of that?
Well, and that again, there's a problem in the US right now because they also want to put out more spending, right? And that will be something that will have, and the tariffs, of course, that will be very inflationary. It will result in a higher budget and so on and so forth. So the market is already playing this playbook that we will have a higher inflation situation, a higher for longer interest rate situation. So of course, ideally you want to, if you have a debt to that extent, you want to take interest rates down, but you're likewise in that dilemma. This is why they're also trying to trade very carefully and working on all sides to make this happen.
Do you think market interest rates in the US will head higher, Stefanie?
No, we think that the US is very much in a position to be able to cut. But we have always been on the position that it's not cutting as much as the market projected in the past. Now we're coming to a very quickly repricing. Every day is a new day. On this one, the market is even talking about no cuts. Some are even talking about a hike now. We think we will see 1 or 2 cuts for this year.
You know, Stefanie, since we're talking about central banks and rates, we have to talk about India as well. And that kind of brings me to a bigger question on India. This whole FPI selling, foreigners have been selling that like there's no tomorrow. Well, yes. A lot of that would be perhaps because of the fact that the US market is doing very well. I want to understand from your perspective, how much is it linked to the India slowdown? And do those concerns at least start getting addressed with what we've seen in the budget and maybe with the rate cut that we get from the RBI today?
Yeah, so the investments from overseas investors into India have been very strong, and as you point out, they've been slowing down. Part of the story has been the slowdown that was seen on the growth side. Another part has been the very big efforts that China is undertaking to make sure their equities market is looking better. So I think we have also seen a bit of a rotation trade going on, but that is not necessarily coming from a macroeconomic concerns backdrop. That's also coming from a valuations concern, because you have been able to ride this wave and then you come to a point where valuations were not as attractive. But then you look at what else you can rotate into the region, and then Japan looked more interesting, and also China is looking more interesting at this point in time. So I think that's a challenge we will have for the time being, and will always be a discussion. But again, once we have a better valuation, and to your point, we're now getting also the growth backdrop addressed with the fiscal policy, maybe with the monetary policy today, then this will be good reasons to go in at better levels.
Okay, all right. Hi, Stefanie and Mayank. Thanks a lot for coming down to the studio. Mayank, let me come across to you then. You know, we have earnings that were looking very, very good till lately in the Indian markets. That slowed down a little bit. Economy is a little bit softish, and the FIs, they've been selling lock, stock and barrel. You know, we haven't seen selling like this over the last 4 months or so. It's the most severe selling that we've seen. Do you think at current reckoning, you know, with the problems being addressed both in the budget and hopefully the RBI eases some liquidity, do you expect the FIs to gradually start coming back into India?
So just to carry on the global narrative, I think if you plot the US 10-year and then you plot the emerging market indices or the Indian index, it's pretty much a very, very high negative correlation. Okay. They almost mirror each other. And whenever you see the US 10-year go above, let's say, a 4.3, 4.4, that's pretty much an inflection point for money to sort of go into the US bonds.
Yes.
And I think from September, when we hit 3.6, and then now we went back up to 4.8 on the 10-year.
Yes.
You've seen this massive flow that's gone into the US, which is why the dollar is so strong as well.
Indeed.
And I think that's a very large reason why you've seen such massive FII selling, because they were really not positioned for this sort of a rise.
Yes.
And therefore, if you're getting 4.5 risk-free rate globally, you sort of go and take your money out of emerging markets. India, of course, bore the brunt of it because valuations were higher than many others.
Indeed.
But this really was sort of the playbook that happened. Going ahead, I think it largely depends on their own domestic markets, their own domiciles, as to what other opportunities they have.
Indeed.
Rather than whether really earnings recovers or not. We are not talking over here that we'll grow 20% from here. We'll probably, if we do well, we'll be double-digit earnings growth.
Indeed.
And therefore, valuations probably come down on the large cap side, but I think the mid and small still remain very, very expensive.
So, Mayank, to just press on that point, interest rate differentials beyond our control, if another market is doing better or has better valuations beyond our control, the only controllable for us is addressing the growth slowdown, right? So can you expand on that point on earnings growth, the realistic level to have? I think FY26, a lot of people are still talking 12, 13%. A, do you think that will be delivered? And B, if yes, then what are we talking about in terms of a market recovery?
So if you look at the macro backdrop, I think earnings growth is probably going to be delivered because we've seen the government act on policy in tandem. The fiscal policy we saw was very, very non-inflationary, and they've continued with all the capex, they've continued with all of that with tax cuts, etc. And monetary policy, it's not just about today, but if you look at the past month or so, RBI has come up with a lot of OMOs, VRRs, and liquidity into the system. So both monetary and fiscal policies were very tight, which have been already loosened up by the government. Capex spending is coming back. We are seeing lesser cash balances of the government with the RBI, which means that they are spending more. So all of this obviously has a lag effect, but over the next 2 quarters, the earnings growth should come back.
12, 13% maybe can be delivered. Yeah. Mayank, because we'll hear from the RBI governor today, how much can they really go out and ease? Because there is a currency as well, right, which has been depreciating. And if you do too much, you risk the currency falling faster. It's adjusted from 84-ish kind of levels where they were trying to hold it. It's come off now. And many say, well, it's much better adjusted to the changed environment globally. But what's your sense?
So the currency is already, I think, down 3% from what it was in October. And that could be a precursor. But I think the imponderables on the global side still are very, very high. You are still at risk of tariffs. You're still at inflationary risk from a lot of actions that could happen globally. And the RBI just might want to be a little circumspect before,
doing too much.
Yeah.
Stefanie, you have a view on gold. I wanted to get that before we run out of time.
Yes.
And that's something which is done so well.
It's been a very strong call next to the positive India call. We've been carrying on the positive gold call from the beginning of last year already, when everybody was still shaking their heads.
So where is it headed? We're at just under 3,000?
I think we have to revise up our forecast as well, because the gold story is very much intact. So there's actually a few very important drivers, and I think it's more or less also an Asia story. So of course you have the central bank kind of diversification. The Chinese have just started to come back meaningfully, even despite the higher prices. and restart the buying. So it's a strategic asset you want to hold from a central bank perspective. I think one of the big drivers also has been and continues to be the Chinese retail investor. And I think that's in the kind of narrative of you have a situation where you're looking for store of value and the property market is still in a stabilizing phase. Stock market is undergoing a stabilization phase right now, but your currency is still under pressure because there's this notion of tariffs coming, and the way you offset it is by lowering your currency. So gold will continue to be a very big investment vehicle, and as long as this continues to be the place, then we need to carry on with our
Where is it headed,
goal.
though? You could give us a level on that. We're at around $2,850, and no one would have ever thought that. But
yes.
How much higher do you think we head from here?
So our forecast was just hit around the 2,800, but I think the 3,000 is most probably more realistic.
Indians are big buyers of gold as well, big importers.
Exactly, it's an Asia story.
And I think if you look
yeah.
at a gold price chart and look at the dollar rupee, it's actually almost exactly positively over a long period of time. It's positively correlated because we're so big importers.
Yes.
So yeah, but we're also big holders.
Just since we're talking commodities and you mentioned gold, just want to round off with if you've been able to model, and this would be hard, what all this tariff talk and the Trump administration's policies are going to mean for commodities in general. Drill, baby, drill. Does it mean that we start penciling in maybe oil at 70 or maybe lower? Have you been able to sort of decipher what that could mean for other materials, commodities, other metals? Though it's a moving target, right? We wake up to new headlines every day, so not easy, I'm sure.
Thanks for the prompt. I think on the commodities front, it's especially interesting. I just want to highlight two things. On the oil side, I think we know what the objective is of the U.S. because that's one way of keeping inflation down if you're able to suppress the price, and there's different ways of doing it. We don't think we can yet talk about much lower prices unless we understand more to the picture. But what I find extremely interesting right now is on the rest of the commodities complex. You have a situation where, especially when you want to bring more of your production onshore, you will have to rely a lot on commodities. And we've been seeing how the commodities complex is also something that has been used in retaliation of tariffs right now. And there is a big import dependency from the US if you want to bring some of the production onshore. But a lot of these commodities are actually in the hand of Asian countries, especially the BRICS Plus. They have been enlarging, and if you look at graphite, nickel, not just what had been used to retaliate, like ammonium, gallium, etc. These are very much supplied to the tune of 70-80% out of these countries. So I think there's an underlying ability to kind of control the supply. At the same time, demand will stay high. So the commodities complex, even in a slower growth environment overall in the world, will be very well supported.
Absolutely.
If that makes sense.
Stefanie
All right.
and Mayank, thank you very much, both of you, for joining us. And do come more often. We enjoyed the chat. I hope you did too. And I hope our audiences did as well. I think